Welcome to the Mortgage Rate Weekly Market Update for the week of June 18, 2018. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you your update. Well, last week, mortgage bonds started off not so good, selling off, moving interest rates higher. But if you take a look at the bond chart on the screen, you can see mortgage bonds were selling off, but then on Wednesday, after the Federal Reserve meeting, mortgage bonds sold off really bad with that long tail down, but recovered and were able to find a floor of support. And then if you look on the green candles after that, Thursday and Friday we were able to follow through on a rebound rally and move all the way up to the 50-day moving average. Now bonds were stopped right there at the 50-day moving average, which they've not been able to break through for a couple weeks now. So that's not a good technical signal. Now starting off this week on Monday, stocks are down 300 basis points. And mortgage bonds are still failing to rally above the 50-day moving average. So that is not a very good sign. So with that in mind, we're going to very, very carefully recommend floating your mortgage interest rate to see if bonds can break above that 50-day moving average. But if the stock market recovers, we will quickly switch to recommending locking your mortgage interest rate, because they're going to the mortgage bonds will sell off if the stock market recovers and starts to rally. So you can carefully float, but you got to watch that stock market. If it starts to recover, you're going to want to go ahead and lock in your mortgage interest rate. Now, if we dig into the economic news, last week, big meeting, the Federal Reserve had their monthly meeting, and in that meeting they announced they're going to raise the short-term Fed funds rate 0.25%, taking it from 1.75 to 2% range. That is the rate at which banks lend each other money overnight. So that's what they charge each other, and then that gets passed on to consumers. For example, the prime rate will go up 0.25% when the Fed funds rate goes up. So your short-term interest rates are moving up about 0.25%, credit cards, all that kind of stuff. Now, long-term interest rates are not directly affected by the Fed funds rate going up, as we saw with the mortgage bonds we just reviewed. They're affected by the price of the bonds, which can be influenced by the stock market and what the Fed's done. So different things. So we actually had mortgage interest rates move slightly lower the end of the week last week in the face of Fed funds rate moving up. So sometimes they do go opposite. But long term, the outlook for mortgage rates is still for them to move up, because with the Fed funds rate going up and the economy doing well, we are looking at inflation to start moving hotter, and inflation is the enemy of bonds. Strong inflation, higher interest rates. So we did see a report last week, the Producer Price Index for May 2018 came out, and it had moved up to 3.1%, which is the largest increase since January 2012. So the Producer Price Index, or the PPI, measures inflation at the wholesale level. Now that came right after we saw the Consumer Price Index, the CPI, which it also came out hot. It moved up from 2.1 to 2.2% year over year on the core. That is again above the Fed's target of 2%. That is hot inflation. If that continues to move up, it's going to put pressure on mortgage bonds to sell off, moving interest rates up. So we'll keep an eye on that. So as the economy does better, inflation kicks in, mortgage rates will continue to move up. Then we saw retail sales for May 2018 jumped 0.8% from April of 2018, which was well above the 0.4% expected. Retail sales are up 5.9% from May of 2017 to May 2018. So retail sales measures consumer spending. If it keeps growing, the U.S. economy will keep growing. And again, if the economy is growing, consumers are spending money, we're going to see inflation kick in. That's not going to be good news for mortgage bonds. So that's more impetus for interest rates to continue to move up, as they have since they hit their lows last year. So be prepared. Don't think you're going to wait and get a better interest rate. A long-term outlook is the longer you wait, the higher the rate you're going to get. Then we saw weekly initial jobless claims come out on Thursday, and they showed 218,000 claims for the week. That's a drop of 4,000 claims from the previous week. It's the weekly initial jobs claims show the labor market's doing very well. Businesses are holding on to their employees, and unemployment is at an 18-year low. So again, more information showing the economy is doing very well, which is bad news for mortgage interest rates. They will continue to move higher as the economy continues to do well. So just be prepared for that. You should be looking at, again, an interest rate between the 5 and 6% range in 2018, moving into 2019. All right, and housing news. CoreLogic released their loan performance insight for March of 2018, which shows loans 30 days or more past due decreased from 4.4% in March of 2017 to only 4.3% in March 2018. And then seriously delinquent loans, which is defined as 90 days or more delinquent, decreased from 2.1% to 1.9%. And that's if you take the sum of the 90-day plus and 120-day plus. That will give you the numbers there that I just quoted. And then the other thing they had in the report was equity growth was up on an average $16,300 per homeowner from March 2017 to March 2018. So the home prices are moving up, which means home equity is increasing for homeowners as home prices move up. So that's good news there. Great housing market, great time to buy. If you buy now, you'll get a lower interest rate than if you wait, and you'll also get a cheaper home. And that means next year your home will be worth more than it is than you bought it this year. If you wait till next year to buy, higher interest rate, higher home price. So economically, it makes sense to buy now. And in the local news, we got Newcastle County, Delaware, voted 7-5 to raise the property taxes 15% effective July 1st, 2018. So that's coming right up. If you want more information on that, we did a blog and a video at DelawareMortgageLoans.net. You can get the full story there. But property taxes, Newcastle County, were voted to go up, and that comes a month after they voted to increase the sewer bills as well. So looks like they're trying to balance the budget on the backs of homeowners and home buyers. If you're not real happy with that, go ahead and reach out to your county counselor or vote them out. In the local news, we also got the next free first-time homebuyer seminar coming up Wednesday, June 27th in Wilmington, Delaware, from 6 p.m. to 8 p.m. at the Independence Mall at eXp Realty office. And then we're back again in Newark on Saturday, July 28th from 10 a.m. to noon at the Christiana Hilton Hotel. You can register for either one of those events. Give us a call in the office, 302-703-0727, or online, www.DelawareHomebuyerSeminar.com. Look forward to seeing you guys next week.